emerging markets, it's a very broad investment universe. Okay, we cover everything from North Asia right the way through Southeast Asia, Africa, all the way down to Latin America, and these are very different markets. Generally speaking, how we would characterize an emerging market in the broadest senses would be levels of GDP per capita, so lower income countries typically, obviously than what you'd see in developed markets. Lower levels of financial sophistication from a capital market perspective. I mean, often a lot of individuals are very surprised that somewhere like South Korea, which is very developed when you visit the country, appears within the emerging market universe. But that is really a function of the nature of South Korean capital markets, which have their own nuances and are not as liberal or as open as what we see elsewhere. But I think what that really lends itself to in terms of how we benchmark is to understand the nuances of each of these markets and what that means for the end businesses that we invest in. Okay, because yes, we invest in an Indian company or a Chinese company or a Brazilian country, but what we really own is the company. Okay, so we own shares in the largest home appliance manufacturer in China. And that's a very different business to the largest bank in China, which we don't own, as the case may be. So it's very important to understand, the companies that we invest in and what the sort of environment around at a country level means for how they steward their capital, how they operate, and therefore their opportunity set. And so that would be one of the kind of key characteristics I'd make around benchmarking. And then also just to understand different macroeconomic sort of fluctuations and how they can improve or disadvantage certain particular countries because of the structure of those economies. And we can get into that if you wish, but there would be some of the broad characterizations that I think it'd be worthy of mention at this point. What we really look to do is to align ourselves in partnerships with good capital allocators at a management team level, with other shareholders whose interests are aligned with our own, and then businesses that have something unique about them that enables them to consistently and sustainably replicate their business models, redeploy capital, and create long-term value for the shareholder. Now, the uniqueness of those sort of businesses that we found in Taiwan, India, and China has largely been around the fact that you've got very, very sizable market opportunities. So you've got great reinvestment potential because of the underpenetration of air conditioning units in India, as the case may be with a stock like a Havells India, which is one of the leading home appliance players. Or you have markets which are formalizing and very quickly in China, there's a rising level of premiumization. So if you think about luxury auto demand for a stock like Zhongsheng, which is the leading auto dealership in China with Mercedes-Benz, Lexus, and BMW partnerships, that rising wealth and level that we've seen in China over the last few years is manifesting itself in an uptrade in terms of product quality, and that benefits the luxury end of auto demand. And so what some of these markets offer us is a volume opportunity because they're underpenetrated in terms of units of consumption, but then also a premiumization opportunity from a pricing perspective for a whole variety of reasons. The biggest opportunity sets have been in those markets as we've seen thus far. I mean, Taiwan would be slightly nuanced. It's much more around the technological capability of the companies that we've invested in. A lot of the world's sort of semiconductor chips, or the vast majority of leading edge semiconductor chips, are manufactured in Taiwan by Taiwan Semiconductor, which we own. It's a very capital intensive industry. TSMC is the leading player, one of the few players that can execute on that. And their technology really enables a huge amount of the global economy without us even realizing it on a day-to-day basis. And that creates opportunities for other businesses in industrial automation, chipset manufacturing for smartphones, and all manner of other devices. And that would be where our exposure in Taiwan lies. And I think it's also, important to recognize that corporate governance and stakeholder alignment is critically important to us. And Taiwan does offer us with a number of companies where you have a very strong owner management alignment in terms of the management of companies being significant shareholders in the business. And so that has very important long-term implications for the sustainability of how those businesses are run, how they allocate capital, and the protection it affords us as minority shareholders who ultimately, allocate capital to corporate managers to do the best thing with. And so that's the other reason why we've always had significant exposure and do find opportunities within Taiwan, I would say. We've dealt with COVID, but in the background, or we're dealing with COVID, but in the background to all of this has been the discussion around climate change, which has been ongoing for a while. But I actually think that the kind of personal level, I think that the public buy-in to the issue of climate change and the awareness of our environment has actually heightened through COVID. And I don't know if it's a consequence of people suddenly taking stock and being aware of their surroundings a little bit more, maybe in particularly in developed markets. But that is leading to almost no kind of pushback on the need for a greener economy, for reduced carbon intensity. And the truth is that shift to that economy is incredibly metals intensive, right? So, China is installing, here's a stat for you. China's installing something like 35 gigawatts of wind power per annum. For reference, per annum, okay, maybe going to 40 from numbers, and it was 25 a year historically. For reference, the UK has something like 20 gigawatts of installed capacity, right? So it's massive. You look at some of these numbers and you sort of can't scale them. It's huge. Now, this is, these turbines are 4 gigawatt per unit normally, or the size of the turbines are much larger. It wouldn't be 4 gigawatt. The size of the turbines are much larger than onshore turbines have been. Now, the copper intensity of those turbines is not a linear relationship in terms of the gigawatt that's being installed, because you've got much larger turbines which require greater levels of copper within them. And then because they're offshore, they have to be linked to a grid. And so that has huge, far higher copper intensity within it as well. You look at battery technology, it's rare metals, it's lithium, it's cobalt, it's nickel intensive. And so the shift from internal combustion engines to EVs, which are taking share in the luxury part of the Chinese auto market, and that's a slight aside, but also a greener economy, it's highly metals intensive. And the mining industry has been under significant pressure for the last decade. The exploration budgets have been cut. No one's built a new mine. No one's found a new resource to build a new mine. These metals are mined in very difficult political jurisdictions. The well-known jurisdictions, the Australias or the Chiles of the world, from a copper perspective, those mines are old. They're not growing production. They've got cost inflation. They've got grade declines, and so the ability of the industry to respond from a supply perspective to this huge demand stimulus that's come in is limited. And that's inflationary. And copper's at $9,000 a ton today, despite the global economy kind of being very weak. And I think that these are inflationary pressures that are going to play up as a consequence of structural shifts in demand and end economy. And most importantly, from our perspective, the supply side has not been able to respond to that. When you think of sort of the scale of balance sheet expansion that we've seen in what have been the historic hard currency countries, so US, UK, Europe, Japan, you've seen huge extension of balance sheets. You've got a 1.9 trillion stimulus coming in the US. Questions as to whether it's enough. There's a huge amount of pump priming going on, and ultimately that liquidity will look for the highest return home that it can find globally. And so I think that on the one hand, that makes other non-dollar, for the most part, assets look attractive, right? Relatively more attractive. Now, I don't know how people, the market will express that however it wishes. It can express it in emerging market equities or equities generally. It can express it in Asian fixed income. It can buy commodities. It can buy Bitcoins, all of these different alternative assets, because they're seen as a relatively better store of value. So I think that's, that will drive liquidity into parts of EM as a consequence of spillover. And then you couple that with a huge amount of pent up demand. COVID was a deep, or has been a huge deflationary shock across the developed world, and there's a lot of pent up demand for when economies start to get unlocked again. And I think that in itself will drive natural sort of inflationary pressures. So I'll get to the point around what does it mean for EM? It means for EM that, as I said right at the top, we've got a very broad investment universe. Okay, you've got commodity importers in the case of Asia, reprocessors in the case of India and Thailand, and you've got commodity producers in EMEA and Latin America. And I think that our opportunity is to make sure that we understand where in a value chain inflation might present itself, and we can seek to protect investors against our clients against that. So we've got large positions in Southern Copper, which we've held, by the way. I've held it for over a decade in terms of the funds that I've invested in one shape or form. But it's a great asset, and it's at a point in the cycle where its return profile is improving dramatically. It's got great reinvestment opportunity sets. We've got we own a company called First Quantum Minerals, another company that I've followed for 15 odd years. It does have a slightly weaker balance sheet than the average stock in our portfolio, so we manage the position size quite carefully. But as a business that's growing production in terms of copper output from its Panamanian mine, it's a very interesting asset that's been, the same management team been in place for a long time. So they're the opportunities. I think one of the challenges is that inflation is generally, depending on how aggressive it becomes, it has the potential to derate these very long-term growth opportunities. And that's the point that I made earlier as well about valuations having re-rated. We do need to be cognizant of potential for yield curves to keep moving up, and what that means for long duration assets of long duration. So valuation of long duration assets like the internet stocks and some of these other companies, like consumer stocks, that have done very well, but maybe the valuations are not providing us with the margin of safety at this juncture. So that's sort of a very whistle-stop tour of inflation on EM, but it's a very interesting topic, at least. You said at the top, emerging markets are not all equal. When it comes to inflationary pressures, they're definitely not all equal. Different terms of trade, as I said, and that has implications for how liquidity tightens or shrinks, and more than that, the end consumer who buys a product in an emerging market, they buy that product because they've got disposable income to purchase it. If the copper price or raw material prices rise, energy prices rise, that disposable income gets crimped. And so you have to, that's an important consideration. And so it has implications for different markets in different ways, depending on where they sit with respect to those pinch points. And that's what we, seek to understand. But ultimately, it always comes back to the stocks that we hold in the portfolio. And they're the businesses that drive the outcomes. For us, somewhat pleasingly, some of the best performers have been stocks that we've held for a very long time, 5 years and beyond. So, and because they've executed on an opportunity set. So you'd have seen a business like TSMC, which I've referenced already, largest semiconductor manufacturer in the world, benefiting from increasing technological intensity of different industries, but also competition falling by the wayside. Intel had some serious issues in terms of their ability to compete at leading edge semis in the middle part of last year. And that really entrenched TSMC's position and their ability to generate consistently attractive returns. So that's remained, an important contributor to the portfolio. We also saw Tektronix Industries, which is a Hong Kong listed power tool manufacturer. It manufactures the Milwaukee power tool brand and also the Ryobi brand for the DIY space. Off of a single battery platform. So the company's sort of uniqueness really, or one of their unique facets, is that they invest very heavily in battery technology. And the idea being that you have a cordless shed essentially at home with a single battery that powers all of your tools. That business has continued to take significant market share, obviously helped by favorable home improvement and the stay-at-home kind of spending as well in the US, where they've got a significant presence. But really just an execution of the opportunity set, and then also I think sort of differentiated sources of returns. Southern Copper is a business that I've never ever been asked about in a client presentation, despite having owned it for so long. And it was one of the, it sort of sits in the portfolio. We've carried it for a while. It's a great asset, but last year it really came into its own in terms of the diversification that it provides the overall portfolio, because it is a different source of our differentiated source of sort of alpha versus your typical North Asian consumerist business. So they would be, some of the kind of key contributors to the portfolio. I think on the other side of the ledger, we did struggle with businesses in Latin America, stocks like Lojas Renner in the consumer space. Well-run asset. It's a clothing retailer, but forced to close all of its stores. And when we're analysing for a protracted period of time, when we're analysing downside risks, we have an understanding of how businesses, will see trading densities and revenue performance sort of get impacted by adverse economic conditions. I have to be perfectly candid. I didn't foresee a closure of every single one of their stores for a significant period of time. So that that has implications for us, but we've learned from that. I mean, we've learned about sustainability of businesses in terms of how they deliver to the customer through an omni-channel process, and I think that puts us in a much better position going forward. On a forward-looking basis, North Asia last year was very strong at a market level. I think that is likely to broaden. It's always difficult to predict the future, but I do think the opportunity set is shifting elsewhere across global emerging markets, and some of the positions in India where we've got a relatively sizable exposure at sort of 15% or so of the portfolio. Domestic financials, domestic consumer businesses, I think are interesting. Increasingly looking, although not yet acting very carefully in South African equities. I think that there's some valuation opportunities as well there, and they've got some economic tailwinds. So I think that they would be some of the elements on a forward-looking basis, just to keep an eye on.